You're listening to the Practical Wealth Show with Curtis May.
Hey guys, welcome to another episode of the Practical Wealth Show. So today with us is Mike Zlotnik. Mike is known in the real estate circles as Big Mike due to his stature. But more importantly, he is known for his personal integrity and also for having a keen understanding of the financial aspects of real estate investing. Mike has in-depth knowledge of expert knowledge in pandemic-created investment opportunities in real estate, what's hot, what's cold, and what things are trending now. Big Mike, welcome to the Practical Wealth Show.
Thank you very much, Curtis. Thank you for having me.
Let's talk about COVID. So the opportunities that you see amid the COVID-19 crisis one of the things is converting hotels to affordable multifamily, but in general, dealing with it as an investor, so tell them a little about what you do, because you run a fund, right? And you're the person that is analyzing the deals, defining the gold within the opportunities and money-making opportunities. So tell them about what you do, and then I want to back into some stuff that they can learn, and towards the end how they could work with you.
Sure. I'm the founder and the CEO of TF Management Group LLC. We're a fund management private real estate syndication company. We do both. We are a family of funds: Tempo Opportunity, Tempo Growth, and Tempo Income. Mm-hmm. They serve three different aspects of the investing: income growth and income. And then we do one-off deals in various aspects of the multifamily storage, conversions of hotels, and so on. So what I do day in and day out, like anything else in investing, you basically have, if you're going to ask me, what do you do day in and day out? I say, I marry money and opportunity. That's what we do. We have investors who invest with us. They have their capital, most of them are passive. And then we have, on the deal flow side, we have a strong network of movers and shakers, the operators, the institutional level, high quality folks with their niche, either multifamily storage, conversions of hotel to multifamily or whatnot. We have quite a number of what I call them jack of one trades. They know what they do, and that they do that extremely well. Mm-hmm. So we identify opportunities, we structure them, we negotiate terms, and then we invest. Sometimes we're passive, sometimes we are a little bit more active. That's what I do day in and day out. It's basically finding the best deals out there with the best operators, putting the right amount of capital into these deals to make sure that they're well capitalized and they're off to a successful path.
As we record this, I don't know if we're ever going to come out of it, because till it's safe again means never. Okay, but I know it's presented challenges, but at the same time, do you see opportunities in that space?
Yeah, COVID. So you started the question about COVID. COVID has been both beauty and a curse. Obviously, it's a huge curse for the society. We lost a lot of great people to this terrible pandemic. Real estate in general, it has been more of an opportunity than a curse. As you know, the market initially responded with the substantial concerns, but then they realized the government response, the U.S. government, other world governments, was to inject a lot of cash into the system. Mm-hmm. And the markets recovered very quickly and started to run even harder than before. The opportunities that it has created, specifically dislocating certain asset classes, and we found it to be very exciting to be investing in the hotel to multifamily conversions. That's one of the asset classes that's been certainly dislocated. And the opportunity, what's really interesting is the opportunity existed pre-COVID, but it's sort of accelerated. It's not COVID created, it's COVID accelerated opportunities. Number of dysfunctional old hotels that were no longer a good product as a hotel became phenomenal conversion opportunities to workforce housing. So we've got a number of great successes already. The thesis is coming to an exit point. So it's no longer a thesis that's actually already proven with multiple deals life cycle. Give you an example, we have one deal we invested September 2020, and it already exited in October of 2021, basically in 13 months, returning essentially, we put $1 million in the deal, we got 2.6 million back. It's crazy returns. If you look at the math, it's 140% IRR.
Yeah.
So that theory actually is holding up really well, and we are beginning to see these exits to be really, really strong. Some other opportunities, again, in the COVID created sort of the pandemic. You got office dislocation, so some office can get converted to multifamily. Some retail was showing initial fractures of stress, and then opportunities to redevelop some of them into storage have accelerated. But overall, we're back to levels well above the pre-pandemic. The market continues to roll along. We're obviously seeing inflation, which is a great friend of many strategies. Obviously, multifamily housing, storage, and so on. So all I'm saying is that as much as it is a terrible thing, COVID, it has actually boosted the economy with everything that has happened after COVID hit, as strange as it sounds. Well, whether we're ever going to come out of this and feel like we're back, I think after some number of years with further development of therapeutics and vaccines, it'll be like a flu, like a seasonal flu. You just get your shot and you're done. Move on to the next one. So that's my view on the COVID.
Yeah,
but we're not there yet.
I think it already is that. But you needed some boogeyman. Even though it's a real thing, it's just like, all right, 99% of people who get it are going to survive. So why you need a vaccine for something that's 99% survivable? Okay, I don't know. That's just me. But,
well, it's the grandma, right? The concern has always been the grandma. Your 90-year-old grandma. If you get sick, you're fine if you're young and healthy. But will the grandma survive? And that's the biggest concern. It's always been like that.
Yeah, exactly. So the approach, if that's the danger, I'm not gonna go there. We're gonna stay on target because I know you got to go. Yeah. But so let's talk about. I want clarification because I want to make sure that the people, because I had a person email me yesterday. It's like, listen, Curtis, he's your person, right? He's an accredited guy looking for syndications of where to put his money. So I'm going to have to send him this thing directly so he can talk to you. But so one of the things you said is that, so in the fund, now I'm curious about how the fund works. So the fund is, because you said something that the operators are the syndicators, the people that build the syndication.
So let me clarify.
Okay,
we're on a family of funds, which we call them funds of funds. So the way each fund functions, it invests into individual deals. So if you think of an individual deal, it could be a multifamily syndication.
Mm-hmm.
So we'll often invest a substantial amount of money into one-off deals. So if there's a deal, for example, they're raising. Let's just use example. It's a value add multifamily. They're raising $5 million in equity and $50 million in debt. Total $20 million acquisition with construction and improvement and projected exit in 5 years for $27 million, right?
Mm-hmm.
So we can write a substantial check in the $5 million raise. Maybe we'll write $2 million check, $3 million check. We take a big piece. So from our funds. So the funds act essentially as a vehicle. Once we identify a deal, we really like the deal. If we really love the deal, we can take the whole deal. If we want to maintain diversification, we don't want to write too big of a check. We'll say, we love the deal, but we'll only write $1 million check in this deal. Why? Because we have to diversify. One of the jobs of the fund manager is to diversify. So how does a fund function? The fund essentially raises capital from many investors.
Mm-hmm.
So you think of it, 100 investors and 20 deals. That's the easiest way to think about it.
Mm-hmm.
100 people write us 100 checks. We take the money, write into 20 deals, spreading the risks among different strategies. We have diversified funds across multiple strategies. In contrast to us, there are single strategy funds. All they do is multifamily. All they do is storage. All they do is shopping. We do a little bit of all, spreading the risk into multiple strategies. And what happens is with this strategy, when COVID hit, we only had a few things that we were nervous about because diversified strategy doesn't get, it spreads the risks among many sectors, strategies, location operators. That's why I love the strategy a whole lot more than just single strategy fund, because their objective is to basically execute on the best they can in that strategy. If that strategy gets beaten up, like COVID hit, and your office buildings got hurt,
right?
And that's those funds were hurt most. Does it make sense? It's more like if you spread the risk among many strategies, you can also reduce the downside and you mitigate any kind of regional or strategy specific or specific sponsor risk. So one of the key jobs I do day in and day out is mitigate risk.
So let me point that out for you all. Even if you have, a one apartment building or, 4 or 5 single families, one of the things, he's not a gunslinger. His number one job is to mitigate risks. And so one of the things I hear is, he's that with other people's money and the money they put into the fund. But also what I want you to hear is, how can this help me? You might not be in a position to be an accredited investor, but these principles work regardless of, you see what I mean? So it's all about the principles. So Mike, I just wanted to point that out so I could hear that. Well, I want them to hear that, right?
Sure, Curtis. So we do take capital only from accredited investors, and no disrespect to unaccredited. Many unaccredited will become accredited soon enough, right? Right. And over time, it's becoming easier and easier to become accredited investors as there's inflation and at least
Yeah, it's only 300,000 or 200,000. I mean, so that's really, if you're working, you could do that, so if your business works well, you could do that pretty easily. Go ahead.
That's right. So it's either net worth outside of primary residence, $1 million, or an income 200 single, 300 married. The point that you are trying to convey is what's the most important thing? The most important thing is really underwriting the deals. If you get into the right deal, you spend the time up front, then you have years worth of great benefits. And the converse is true. You get into the wrong deal, you have years worth of pain. So it's critically important to identify. And the way we go through the underwriting process, just to give you a little insight, is you always start with who you're investing with, the operator. You have to know, like, and trust. You have to build confidence that they are trustworthy, they're high integrity, they have the ability, the knowledge, good communication, all the elements that comprise a good operator need to be there. Once we get that confidence, we look at the deal. The deal could be a phenomenal deal, but if it's with an operator we don't know, we'll never write a check. I wanted to convey a very important point. Ton of people look at the bright and shiny objects. Oh, they got another wonderful email, and it says IRR 350%, right? Wonderful. Oh, what's the operator, whoever's offering? I have no idea. Some guy on the internet, they say you can make 357% a year. Why not 1,000%? Why not 1,000,000%?
Right.
I heard schemes with the Bitcoin. You could do this, and you could suddenly. I mean, Bitcoin itself has become sort of a blockbuster, but at the same time, you don't know the garbage from the real thing. There's probably for every one real thing, there's 1,000 terrible things or things you're going to lose your money on. I'm not an advocate of crypto at all because I don't understand how they make money. It's pure speculation. One of the big differences between investing and speculating, they are all projecting Bitcoin is going to go to $100,000 and then $1 million, right, over some period of time.
Right.
Pure speculation. With us, with real estate, through value add strategy, you can actually understand you bought the property all in $20 million, including construction budget. By the time you're done, based on the projected numbers, this property should be worth 27 million or 25 million. Why? Because similar things trade like that. So the value add creates what is known as forced appreciation.
Well, and so, we talked about this a little bit last. We were talking I call in the green room, but we both, you've read it. I've skimmed it. The Benjamin Graham, the Barn book. And the quote was, what's an investment? Something you put your money into that where your principal is safe and you've got a reasonable opportunity to make a profit. That's an investment, right?
That's
Everything else is speculating. That's
exactly correct. Yeah, I believe he says it's an operation. He uses the word
right, an operation, right? There's
official. There's a safety of principle and an adequate rate of return. And that is exactly how we think. It's not about return on investment first. First, it's return of the investment. The way I call it, one of the most important questions I ask on any deal, and there's no right or wrong answer, but by far, what's the most important question is, what is my downside protection?
Yes.
What creates the safety on the print? And by the way, there are plenty of deals that there is no protection. Right? It's just so risky and speculative, but you need to know that.
Yeah.
So what's my downside protection? Well, downside protection, depending on the kind of a deal, if you make a loan on a property, for example, it's your loan to value ratio. It's a conservative risk level that you're taking with a loan. If, on the other hand, if you're investing in the equity of the deal, what's my downside protection? You could say very, very competent operator, very successful track record with value add strategy, great location, great cost basis. All these things would make sort of parts of a downside protection. And you have to know and you have to feel good about what each deal's downside protection is, then you have a reasonable degree of an investment. Everything else is speculative, because what's your downside protection on Bitcoin investment?
None whatsoever.
Well, people are going to say, well, it's the scarcity of the Bitcoins. If the chain is broken somehow, again, I'm not advocating against it, but somehow there's a break in technology, it's gone. There's nothing behind it. So again, not picking on Bitcoin for any other reason, then I don't see Bitcoin any downside protection in Bitcoin. At least I as far as I understand that because there's nothing behind it. There's no print.
Right. So in your mind, like with just no downside, like I tell people, look, you're grown, but you need to have, I want people to have like liquidity. I want people to have, 6 to 12 months of liquidity, right? Just on basic principles, right? My fourth principle of what we teach is you want certainty. Most people don't have enough certainty, and all they do is speculate, right? And so if you got some fundamental things that you understand, and okay, you got a little bit of play money that you can afford to. I tell people, look, speculating is the money you would go to like we're near Atlantic City here in Philly, right? To go to Atlantic City with. That's your land. Because if you want to gamble, at least if you go to casino, you get, a buffet and a show and, some comp drinks. If you want to gamble, they don't give you none of that stuff at Wall Street, right? But I think that's key. I want you to go into a little bit of the questions that you asked that I know there's probably like 10 or so, but 2 or 3 or 4 of the questions that people should be thinking about before they invest in any, fund or syndication. Because I think a lot of people don't know what they don't know or what they should be looking at, because it all looks, the numbers look good and the performance look good, but they don't know, starting with the operator. But even then, there might be some other stuff. Maybe.
Yeah, I appreciate the question, Curtis. So I would say number one, obviously, don't invest the money you can't afford to lose. That's one of the rules of investment.
That's rule number one.
So,
yes.
Yeah. Unfortunately, people want the safety and they want great returns and everything else, and those are mutually exclusive things. I would say, like following your methodology and your strategy and your teachings, don't invest the money you set aside as your reserves, right? Mm-hmm. You gotta have reserves for a rainy day, right? Once you pass that, you have investable capital, then you can go through a series of questions. So obviously, one of the really basic questions: are you investing for income or are you investing for growth? Mm-hmm. Really important question. Mm-hmm. If you're on a high tax bracket, you're a high earner, and you're going to invest for income, it may be taxed at a high tax bracket. So tax efficiency question also follows up: income, growth, tax efficiency. Then at the end of the day, you ask another great question: liquidity. Some funds have liquidity, some don't. So when you invest, ask the question: how liquid is the investment? Is the ability to redeem investment or not? Mm-hmm. If you invest into a 5-year syndication, you have no liquidity. You're stuck in a deal for 5 years. You may get the cash flow. So obviously, liquidity of investment is incredibly important. If it's illiquid, just know it's illiquid. There's nothing wrong with this.
Right. But most of the best investments are illiquid. That's why you have to have liquidity. You need to not be able to touch it. So you can because it's not like a mutual fund where you can just sell your shares. It's illiquid. That's one of the advantages if you're ready for it.
That's right. So I'll give you an example. There are different instruments, and we have what I call the classic closed-ended fund, which basically is a liquid fund that invests money 5 to 7 years, called Tempo Growth Fund. It's targeted best risk-adjusted return in its mandate. It doesn't care about liquidity. It doesn't have any requirements for liquidity. But we do have 2 open-ended funds called Tempo Opportunity and Tempo Income Fund, and they do allow for quarterly redemptions. So some funds have redemption mechanism like Wall Street, but understand real estate is not the same liquidity as Wall Street. You sell a stock, next day you can get your money back. With even open-ended funds with liquidity. Yeah. You typically still only redeem once a quarter. So just to be clear, it's not the same. Mm-hmm. But some of the questions to ask, and I have a book out on Amazon, not promoting the book, but I do talk about
promote the book. It's all good.
Top 10 questions to ask. The book is called How to Choose a Smart Real Estate Investment Fund. Top 10 questions to ask before you invest in a fund. Mm-hmm. So number one question is, what is the security of the investment? That's the question. What's the downside protection? Mm-hmm. How secure it is? What's protecting me from losing the money? Number 2 question, what is the projected return on investment? Just be very, very, very smart about the question. If somebody says, I'm going to guarantee you this wonderful 12% return guaranteed, safe, secure. You know who did that? There's this guy, you heard a little bit about this, called Bernie Madoff. Guaranteed 12%.
Right.
Just be very, very careful. The word guaranteed, to me, is very few things are guaranteed in life. It's death and taxes. Everything else,
Right.
somebody is insuring it. There are no guarantees. Ultimately,
Right.
there's a targeted return, not a guaranteed return. And you have to understand what's driving the target return. You have to understand how whatever the fund or deal is going to make money.
Mm-hmm.
Okay, so what's the return on investment? Then the fund in income and taxation. How does it make income? Is it long-term capital gains? Is it current income that's taxed at the highest rate? And what your tax liabilities are going to be? Does it pass through depreciation, which may be a shield against current income, right?
Mm-hmm.
So some of those questions are very important. Question number 4, which we talked a little bit about, this liquidity of the investment, right? So whether it's liquid on some kind of redemption mechanism or completely liquid, just understand again, liquidity is not the same on Wall Street as it is on the main street or real estate. Very different things. It can be liquid, but not the way you think you sell a mutual fund. If you want liquidity, stick with liquid investments. Real estate is naturally liquid. Just be very, very clear about that. Then question number 5, what are the fund fees? When you invest into something, what you want to see is alignment of interest, where a syndicator, a fund manager, they make money when you make money. When you're successful, then the fund manager gets paid. So it's more important to see greater compensation for a fund manager through performance fees versus upfront fees. Too many operators I've seen, they will charge a big asset acquisition fee, heavy development fees. Whether it succeeds or not, they get paid. I personally don't like those situations, but they're different. Small asset acquisition fees is acceptable, but in general, you want to see alignment of interest. Whether you get some kind of a pref, and then there's a performance upside for the fund manager when you generate a good upside. So I'll give you an example. In our Tempo Growth Fund, we pay investors 8% pref.
Mm-hmm.
And above that, once we get investors to 8% pref, we have a split either 80-20 or 70-30. So investors get generally giant side of the upside. They get 8 pref and then the 80% of the upside or 70%. What I don't like to see is when the investors are taken to the cleaners first, and then the fund managers are concerned more about their enrichment versus the alignment of interest with investors. So again, fees are very important. Frequency of the payout, management team experience and track record, quality of the cash flow. So some deals they're based on highly leveraged deal, and the quality of the cash flow may go away because they depend on some external functions that can run out. So I'll give you some examples outside of real estate, and then we can talk about real estate. So there are funds that are linked to oil price, right? If the price is up, they get paid wonderfully. The moment the price drops, the payout ratio falls, and they can even lose money.
Wow.
On real estate, just for sake of example, you can have deals with high leverage. If these deals, and they run on what is known as a interest-only loan. When the interest-only loan runs out, and then there is a principal interest payment, the cash flow distributions can get caught. Mm-hmm. So you need to understand how the loan is structured. Just a couple of other quick items. So we talked about open-ended versus closed-ended, and then the fund strategies. What does the fund invest into? How it makes money, what type of asset class, and so on. So some of the questions that are worth asking before writing a check into any kind of a fund or a syndication.
Absolutely. So those are good questions. So tell them the book again and where they can find it.
Amazon. The book is literally 30 pages, almost like a pamphlet, and you can get an e-copy or version of it. And honestly, the book is written. I only did the first revision, and it is not. How should I put it? It's raw, but because it's raw, it's actually very good. It doesn't have fancy editing. It's just a very raw concepts that are very simple to understand. Right. How to choose a smart real estate investment fund. The top 10 questions or the biggest mistakes to avoid before investing in a fund. How to choose a smart real estate investment fund.
All right, so we're going to put that in the show notes. What did I ask you that you want to share and tell them how, if they want to find out more about your funds and follow you and what you're doing, what's the best way to do that?
Sure. So appreciate Curtis having me on your podcast. I have a podcast too with a cheesy name, Big Mike Fund. Just all they have to remember is Big Mike Fund. And if they get the D, they forget the D at the end, you just type it bigmikefund.com.
Okay.
I promise it's not a kinky site.
Right.
But I am a fund manager. I'm a real estate investor. Love real estate. I have some really cool guests on my show, including you.
Yeah, yes, right.
So, yeah, so we do have phenomenal folks who come on a podcast, and we talk about cool things. And easiest way, just go to bigmikefund.com, and that's the entry point to our ecosystem.
All right. All right. So, Mike, this was great. We will get I have some of your fund, the book. We're going to get those in the show notes, some of your other contact information I have here. And so hopefully what you guys heard is, so some of you are in position to invest with him, or even if you're not, what I want you to hear is, what do we always say? Investing is not about buying something. It's about becoming something. And so what I want you to hear is his mindset. He starts with how to protect his risks. He starts with how to analyze deals. And he's also mentioned different asset classes, because it's still, they work. It just depends on the underlying asset class. But his favorite is real estate. But you can look at anything that cash flows and learn how to ask good questions. So hopefully, Mike, I want to make sure they're thinking right as they hear this stuff.
Yeah, I like to crack this joke. I leave you with the question, not the answer, because the question, depending on how you look at the question, all it does is stimulates the thought process and learning process. That's all it is. Okay. Are you learning to invest or investing to learn? I mean, just spell it out a little bit.
Yeah.
So when you are investing to learn, you typically spend money and you're going to a school, you're getting your undergraduate, your PhD, your master's degree, or you're just investing and you're learning as you do it, right? So very important, every time you invest, also try to learn from your investment. Whatever your investment is, if we write an investment check, what do I do as a fund manager? I actually sit on the quarterly calls and I try to understand how the investment is doing and what are the issues are they having and what are the great things they're doing. So by investing, you're trying to learn more to get better at that, right? That is the first part of the question.
Right.
And the second part of the question, you're learning to invest. So you're not yet writing a check, but you're spending time educating yourself so you can actually write the check next. Sometimes you have to measure 7 times at cut once. And sometimes you have to actually take this step, because if you don't take the step, if you don't put your money into anything, you're going to take analysis paralysis to the nth degree.
Yes.
That's why the investing is not a game of perfection. It's a game of taking steps and learning from your steps. Sometimes you'll find a great deal and you'll learn very little from it. And sometimes you'll make a mistake and you'll lose money, but you're going to learn a lot.
There you go. I'm going to let that be the final word. Y'all need to go back and replay this part. Okay. We just said there, because just gave y'all gold in like a minute and a half. And so Big Mike, thank you so much for being a guest on the Practical Wealth Show. I look to stay in touch and keep us abreast of what's going on in the marketplace. You got, I just scratched the surface of what he can share with y'all guys. So
thank you, Curtis. Appreciate you having me on the podcast.
Yeah, my pleasure. So guys, go out there, make it a prosperous day, and listen, like, and share, and leave us a review.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before sending